I think at the moment the interest rate environment is quite favourable for emerging markets. The situation you've had certainly last year was higher US rates and a stronger dollar, which traditionally is quite negative for emerging markets due to the need of emerging market central banks to raise rates to support their currencies. As we went through the start of this year, we saw a shift in stance from the Fed. We've started to see lower US interest rates come through, which is having a beneficial effect on emerging markets because central banks are now able to cut rates. So this year we've seen a very broad set of interest rate cuts around many emerging markets, so big cuts that have come out of Turkey, Brazil, India, Russia. So now that all major EM, or most major EM central banks are on an easing stance, that potentially boosts domestic demand within emerging markets. And that comes at a time of quite high volatility within EM. There's been a lot of volatility driven by the kind of ebbs and flows of the trade war and the rhetoric that's been coming from both sides related to that. Currently we're in a slightly nicer phase where the market is beginning to discount a resolution to the trade war in October. Which may well happen, but on the other hand, it may flare up again, and much depends on President Trump's stance towards how he wants to use the trade war issue within the upcoming presidential election cycle. But certainly a base case is likely to be more volatility going forward caused by that issue. There certainly isn't a long-term opportunity in emerging markets at the moment. The market is nervous about trade issues. The market is certainly nervous about some of the economic data that's been coming through recently, showing that there is a fairly broad economic slowdown going on at the moment across the world. But that has also meant that share prices have reacted to that, and certainly for investors with a willing to take a long-term view on holding emerging market assets, there's some very good opportunities out there across the globe. Certainly emerging markets are a hugely diverse set of countries that you can invest in. Emerging markets really lumps together completely, or countries which are very different stages in their growth cycles. You have Pakistan on one side, and then you have much more developed nations like Taiwan and Korea on the other side, which are practically developed markets. So from that perspective, it is very important to be very selective in terms of the types of assets that you're buying. And we've always believed that a bottom-up, kind of long-only approach really gives you the best opportunity to be able to find those specific companies to invest in emerging markets that will provide long-term upside. What's great about closed-end fund structures are that you can take positions in smaller, less liquid companies much more easily than in an open-ended fund structure. So typically within a closed-end fund structure, you have essentially a larger opportunity set available to you for investing in emerging markets. So for instance, it's quite hard to invest in less liquid countries like Vietnam within an open-ended structure because of the way those particular assets trade. Whereas in a closed-end structure where you don't have redemptions or inflows coming from investors, you can actually own those stocks with a much more long-term view in mind. Certainly with the backdrop of global trade tensions escalating, India is a market where we find an awful lot of value today. What's particularly exciting about India at the moment has been the re-election of Modi into his second term, and he certainly still continues to follow a very aggressive reform agenda. We've seen significant interest rates cuts come out of the central bank, which has been boosting domestic demand, and more recently, within the last couple of days, we've seen a very significant reduction of the corporate tax rate within India, specifically designed to get companies spending and investing capex again. That combined with the fact that within India there's likely to be 140 million new middle-income households added within the next 5 years provides an enormous tailwind for consumer demand within that country. So India, being one of the markets which is less impacted by a trade war, should be relatively insulated from some of those issues.